Everybody, welcome to week 145, and we are color coordinated today. We have the BGW studios in the Innovation Conference Room, and we had a live event today, so we were here in the office with our all hands meeting on, what day is it? Jack, do you know what today is?
Yeah, I thought that we were all supposed to get dressed up for today. I thought
No.
we said-
No.
Okay.
No, it's Groundhog Day.
That's what I mean. I thought we said on Groundhog Day we're all getting dressed up. Maybe that was
No.
okay.
That would
All right.
never have been coming out of my mouth. No. But hey, the last 3 years have felt like Groundhog Day in many regards. So anyway, we tried to do a poll. I worked dutifully on it, and for some reason it wouldn't save. So we're going to ask you guys to hit us up in the chat with answers to these questions. So these are yes, no questions. We're going to talk about IRS triggers today for an audit because, hey, we're in the thick of tax season right now. So we'll do some yes, no, and we'll see where people wind up. I wish I could get the poll right, but for some reason, it's probably a user error. And then we're also going to talk about some stuff about, working with a bank, especially, with storm clouds looming out there on recessionary fronts, blah, 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 just pressures out there in the marketplace. What are some things that we found? And so Adam has some of his illustrations that should be good. So I'm excited about that. And Jack, thank you for wearing your Carolina blue tie. I am wearing Carolina blue, even though I have no ties to Carolina. So there you go. Anything you want to kick us off with, though, to begin with, Adam?
You want me to do the poll questions now?
Yeah, let's do poll questions.
Yeah. So, all right. So just again, as Gary said, just hit up in the chat your poll questions. These represent the three most common, is that going to be a red flag? Things that I get asked in our client meetings. So the first one is, my sales are up. So sales are doing great, growing company. But man, my bottom line's down. I'm just not showing as much income, relative to those sales. Is that going to be a red flag?
Ooh,
So survey says, is that a trigger? Sales up, but bottom line isn't the same percentage of sales as it was in the prior year.
All right, come on, guys. Hit us up. Hit us in the chat. And I knew Papa Joe would be the first one on here if he was in here, but he's not on the chat yet. So hit us in the chat. Top line is up. Bottom line is down. Is that an IRS tax audit trigger? What do you guys think?
Thanks, Jack.
Jack has answered. Anybody else? You guys can't see because it's just to the hosts and panelists, which would be the three of us.
Yeah. Anyway, all right. So you guys are all sleepy. It's raining.
Come on.
The answer is no. That is not a red flag. The IRS, contrary to popular opinion, does not set up these, I've got a 10% bottom line percentage, variance thing, therefore it's going to be a red flag. I mean, if that was really the case, how many of our clients would be audited every year? It'd be freaking crazy because everybody has natural, kind of ebbs and flows. It's like, hey, things are going to be really great, so I'm hiring ahead of demand, so I've just got a little bit more expense this year that's going to make up for itself next year. I'm a cash basis taxpayer, and I've got an accrual to cash swing this year because I had some customers that didn't pay me. Another reason that could happen. So that is not a red flag based on experience.
Woo.
Here's another one of my favorites. So, company, I'm an S corporation. company made $500,000, don't I need to take, kind of a $250,000 and $300,000 W-2 to be considered reasonable with the IRS? Because I hear that S corporations have to take reasonable wages. I mean, if my W-2 isn't really big, isn't that going to be a red flag?
Ooh, hit us up in the chat. What do you guys think? Basically 50% for you non-math majors.
Yeah.
So Jack, you were wrong on the first one. So you do not get a Starbucks card from Shoemaker Law. Anyone out there? Come on,
I was
guys.
just messing with you guys.
Yeah,
So,
right.
so the
I have the
answer-
list in front of me.
yeah. So the answer to that is no. When it comes to reasonable wages in S corporations, if you don't have any reported wages for the officer, yes, that is in fact something that will raise a flag at the IRS. That's a legit statement that has actually happened to BGW clients against our better advice. So that can happen. That being said, generally tax courts have upheld that a reasonable wage in an S corporation is anywhere between 30% of what you made pre-W-2. So in the $500,000 scenario, that would be $150,000 would be considered reasonable. The rest could be taken as distributions, big tax savings if you do it that way. Or the FICA limit. So same scenario, I made $1 million. As long as I'm at the Social Security limit, I'm going to be fine. What I'd also say about the reasonable compensation argument is that, there's really in BGW world, there's no reason unless there's shareholder equality issues that you're sorting through that anybody should ever take above round numbers, $300,000, which is the absolute max that you can have for the purposes of a 401k profit sharing contribution. That's the max we're ever going to advise a client to take. Everybody else is going to be kind of FICA limit range. And if you kind of think about it, most of BGW World's clients are, small to mid-sized companies. If you just look at compensation surveys of small to mid-sized companies, what do the CEOs, COOs, which are typically what the owners or roles are playing, what do they make? It's kind of in the 150 to 250 range. Like if you had to hire somebody from the street, that's what they're going to take. So there's no argument for don't I always have to be at 50%? That's ridiculous. It's never been an issue. In fact, in the loan audit that I've had where, the people did not take a wage, so we had to impute one. Social Security limit was the number, even though these guys made millions of dollars, Social Security limit was the number that the auditor agreed to. So the last one that I'm a huge fan of, you can't tell there's a theme here, guys. I don't want to file early. That's a red flag because they get their samples from that early batch of people that file. And, once they kind of pick all the people that, they've reached their quota of people that they're going to audit, then they're done. They're not going to pick anybody else. So I want to be last, in line, not first. I'll save you the effort. That is also not a red flag, Gary. Not a red flag.
So interesting. I had never heard that one because when I wasn't K1, I always liked file early. K1's different story. But the second scenario is one of those areas where we see time and time and time again with people that are prospects that come to us when we do an insights analysis on their last 2 years of tax returns. That is low-hanging fruit that usually they got really conservative advice from their CPAs that cost them a lot of money.
Yep.
I mean, we see it every day. And then they become mad that their other CPA was so conservative. So anyway, we aren't ever going to say anything that's non-defensible, that's illegal or unethical. Never, 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 never. But we are going to give you the spectrum of what is in the legal and ethical guidelines that are fully defensible but you must follow the rules, and you got to do what is recommended. And fortunately, we have a very good track record with the IRS. So anyway, so Jack, you've been silent. Oh, there is another like UNC theme here. So Adam, if you can't tell, he does have the Carolina Blue t-shirt on, the official Carolina Blue t-shirt. Jack, you've got the Carolina Blue tie. You're kind of upstaging us, but why don't you go ahead and give us some of your rants, because I'm sure there's something going on in Washington that you've been following.
Yeah, so and I have some other audit triggers to discuss and for your consideration, and whether they're yes or no, and then actually some statistics as well. But as far as what's going on in Washington, you guys have probably heard that there was McCarthy and the president met to talk about things, and of course they said that there's some common space between with the State of the Union address coming up next week. We'll see the president standing in the forefront with McCarthy standing behind or sitting behind him. We'll see how that goes. And so but kind of the same thing, which is that we've talked about before, which is a standoff. And are the stewards of our government going to allow us to, for even a nanosecond, be deemed insolvent? And I think the likelihood of that happening is close to zero, even with the posturing, because of the consequences for that. And I think they will continue to put band-aids on it until they get it straight. It is being used as leverage and again, this is not a political statement. This is just what's being reported, is that Republicans are using it to slash spending, and Democrats are using it to fund what they've already committed to. And so you have this battle back and forth, and there's a lot of horse trading going on in the halls on Capitol Hill, and we'll see what happens. But they keep kicking the can down the road. At some point, you can't do that, and you have to. We'll be into next year's budget and everything else before you know it. I still can't believe we're 1 month down or done with in 2023.
Crazy.
So a couple of statistics, and these are geared towards individuals, but statistically, some of the information is relevant to all of us as business owners. So the statistics are, and I'll put this over here, so looking towards the camera. Last year, and this is fiscal year 2022, last year over 164 million individual income tax returns were filed. The IRS audited 626,000, down from 659,000, which is not a whole lot down during fiscal year 21. Less than 100,000 of these, so less than 100,000 of the 656 or 626 were regular audits in contrast to what are called correspondence audits. And maybe you want to chime in on what exactly that means as being statistically relevant.
Hey, we've got a question. We need a little bit more information before we give you the benefit of this.
Okay. And that means that odds of an audit had fallen to 3.8 out of every 1,000 returns, or 38%. So, and then for 21,
that's 0.038. That's
0.38%. Yes,
yeah,
sorry.
Less than
Missed the decimal point.
for those listening.
missed the decimal or two. And then it was 0.41% in the prior year. So it's gone down statistically, but I don't know how meaningfully statistically that is. So, I consulted.
Hey, put that in context, those 87,000 IRS agents, they're coming for you. They're coming for you. At best, maybe that gets up to 0.5%. So just, for all the fear that's out there, let's just put that in context.
We're anti-fear tactic today.
Yeah.
So there you go.
Yeah.
All right. So in doing my research, I consulted the foremost authority on all things, everything, which is I did a Google search.
Oh,
so
yeah.
I found this article, and it's slanted a little bit, but it has the things that you guys talked about as not being triggers. Some of the things that they said, which kind of makes sense, is number 3 on the list was filing a return with math errors, even if a mistake is in favor of the IRS. But the likelihood of that happening because we're using tax software, whether on your own or, having your CPAs do it, which you should have your CPAs do that, then that, reduces that. The home office deduction is apparently something suspicious because there's supposed to be an area that is used exclusively and dedicated to your business. And so I don't know if you guys have any thoughts on what you see people actually doing with respect to saying, okay, the bedroom that I use in my house as an office has this many square feet, therefore it's a percentage of the total household, and therefore multiply that number by the cost of running the house, whether it's electric or whatever it may be, electricity or whatever it may be.
Yeah, from the, we get asked, it's a good one, Jack, because we get asked a whole lot, home office deduction, blah, blah, blah. There's a form you have to fill out associated with it. So the reason that we're just, we try to get to the same answer through different mechanisms is because if you really think about it, like, there's an old common expression, pigs get fat, hogs get slaughtered. You get it's all on TikTok that, my stairs,
Oh gosh.
should be counted as part of my, usable square footage for that office, which then creates an additional $500 of deduction. That's not anything, $500 of deduction saved you $150 in taxes. That's not nothing. Like, I would like $150, but just increase your odds, of having hey, we wonder about that. So to Jack's point on this one, it's like, what's going to get you a trigger? The IRS isn't stupid. They kind of know the average median home price. I think right now in the US, it's about, $250,000, $300,000, right? So if you think about that, the mortgage payment on that is going to be roughly, $2,000 a month. So you got $24,000 in a mortgage payment, which is principal and interest. So $24,000 a year in principal and interest payments. I don't know what the average utility bill is, but let's say it's $300 a month. So you got, or $300 a month, maybe call it $500, make it even. So you got $30,000 in potential home office expenses. That's for your whole house, by the way.
Right.
That's not for your isolated space. If you're claiming $10,000 in home office expense, you're a freaking moron.
Yeah.
Because there's not a world where that's really going to be supportable. So that's where it's just like, don't be an idiot. It's real simple. You're at best, your potential was $30,000, and even that's not right, because technically it's supposed to be the interest component of the home mortgage, and then a
That's
little
right.
bit of depreciation. So just don't be a moron, and people try to be morons.
Yeah, I think what we see, because a lot of times prospects come to us and they go, oh, well, we were, told don't do that. Well, with COVID and other things, and I can tell you for 30 plus years, I've had a freelance business or a consulting business on the side, et cetera. And I did home office by God's grace, never got audited, but we're super conservative. I mean, it's like, I don't take anything for the principal on the home, and it's maybe like 5%, 5.6% of my total living space. Well, you take 5% of your utilities, which are under $300 a month, and I mean, it's not much. It's it's more work, quite frankly, for me to calculate it and find and support all the documents, and I do, but just don't be an idiot.
Yeah, related, another one that we get all the time, Jack, is people talk the Augusta rule. That's like a favorite of, you go to these companies that specialize in getting paid for finding you additional deductions and tax credits, and the one they love is the Augusta rule. It's like, CPAs, they don't know about the Augusta rule. So the Augusta rule is appropriately named because the citizens of Augusta wanted to be able to rent their homes for the Masters tournament and not have to pay income or not have to recognize that rent as income. So however they pulled that off, they
Lobbying.
basically got written into the code. You can rent your home or any property you have for, I believe it's up to 10 or 14 days. I can't remember off the top of my head, and not recognize the income. You can't have the expenses associated with it either, but you don't have to pick up the income. So if I rent my home for, so many days to Gary for $1,000 a day, that's $10,000. I get to claim that, without recognizing any income. Well, again, you go back to don't be a moron. First off, I don't know. I mean, my house is pretty nice, man, but if I go look in VRBO, I'm pretty sure I could rent a comparable because I got to establish a rate, right? And what other source do I have but VRBO? And maybe that's $250 for a night for a house in Davidson, and then secondly, sure, I get up to 10 days or 14 days, whatever it is. What was my company justification for that again? My annual meetings, I don't know. I mean, did I really have annual meetings spanning, 10 days, 14 days, strategic planning retreats, whatever? It's like, personally, I'd rather deduct a freaking oh yeah. And then if I try to throw a vacation in on top of that, well, which one was it? Was it my house or was it the vacation? The count. In other words, that's another one that if you did, look, if that's all that's left, maybe we'll consider it, but that's another one that's just dumb. Unless you truly are doing VRBO for a big event, then it's really smart. But renting
Yeah.
it from yourself when there are so many other things that you could be deducting, like the vacation that could be the annual meeting, that are better deductions that are contradictory to the Augusta rule. Just want to punch those tax people in the face.
So I want to remind, I'm going to post this or send you this link, Gary, so that way you can maybe repost it to all, which
cool.
is the link to the prior sessions of this broadcast that, and in there, if I know you guys remember, but for those of you in the audience remember, had one of my young colleagues who's a former IRS agent, and we put him on the spot and asked him some questions about potential audits and what might be red flags. And so I refer you back to those. There were part 1 and part 2 that had some of this information in there. So, and now I'm going to put you guys on the spot, and feel free to answer as specifically or nebulously as you wish, but 2 other common deductions or attempted deductions with respect to personal automobile used for business and cell phones that we tend to have, 2 or 3 accounts on. One is work, one is personal, one may be for spam, whatever it may be, but you are mentally switching between those likely. And so how do you allocate, if any, the expense, the monthly expense of having a Verizon account if you can deduct it? How do you guys feel about that?
So I think first off, where do you, with the cell phone bill in general, one of the things you also got to just, be cognizant of is if you finance the device, technically that should probably be, separately stated. But the, from that perspective, what do we do? I'm just going to be straight. Unless it's egregious, we're probably going to let the thing typically pass, even though it may not be technically correct, as long as it's not egregious, because most add-ons to the main plan are, $5-10 a month. I mean, they're not ridiculously expensive, therefore, you're kind of hitting in the non-reportable compensation, level of the, whether it's a gift or it's a, an award that you don't have to claim or whatever, and generally, unless it's a couple $100, which equates to about $1,000 of a deduction, the IRS is going to pass in the adjustment anyway. So we don't, unless it's like really, really big, we're not going to do a whole lot in the allocation. But the technically correct answer is you probably shouldn't be deducting your kid's cell phone bill. Yeah.
Yeah, and I've seen more so that the clients, and maybe hypothetically, I might do this, which is to take the core amount, but not the ancillary phones that are attached, the whatever,
Yeah.
$40 a month extra or whatever it is for data and stuff. But, and then, if there's any fees for like being overseas or anything, like, the $10 a month you pay to Verizon when, even when you're on vacation, but you're doing business stuff. So, maybe I shouldn't have said that, but I think I see that more common, and not just saying, well, I'm going to deduct my $200 bill completely, even though there's other stuff on there. So, okay. And then what about the car?
Yeah, so this is another one that we get asked a question on a lot, that, it's easiest just to explain it in the sense of, well, what absolutely, because people are, oh, your car, can I really do that? My outside of the house and stuff like that. It's easier to start with like my neighbor Tom, who will remain last name unnamed. So his company gave him a car. He's in medical device sales. His company gave him a car. He is a salesperson who works out of a home office. So clearly the company wants to have an expense benefit associated with, we gave Tom a car because he's got to go call on customers. So the expense for the company is 100% of the car, because I gave Tom in my car, I gave Tom a car, but for Tom, the income associated with having the car is basically the weekend usage. So call it, 100 days out of 365. That's the imputed value that's going to show up on Tom's W-2. So if you just sort of apply that same logic, that's how you get to the business owner, car expense that's going to be allowable. So what we typically do with our clients is that instead of deducting the full car like Tom did, we just, because the business owner in this case is the employee. It's like, what am I supposed to do? Deduct the full value of the car and then impute, some money back in my debit? That's dumb. Instead, we just take a pro rata share of the car. Unless you got two cars at home. So, if you're driving company work truck, and at home is the Canyonero, Jack, that's going to cause a Google. I hope he's going to Google that real quick and see a picture of the Canyonero. At home, that Canyonero. Then you kind of your argument would be, I'd taken 100% of the truck because I drive the Canyonero on the weekends.
Mine was a Nova, actually.
Yeah.
Which is actually a big joke because in Spanish it means it doesn't go, right? Yeah, no go. But it's similar experience in that my wife has a company car, and during COVID, obviously not driving it around as much. And what her company does is they deduct the value of, and you previously was a percentage of the total mileage, and assuming, and she logs the miles somehow, but obviously there was not a whole lot of work miles, business miles, and there was a lot of personal miles going to the grocery store and doing other things, because she wasn't traveling as much, because she wasn't permitted to be she's in the medical field, to be in these buildings. And so it was interesting for our combined income to see that. And they wait until the end of the year, which I would maybe prefer them to kind of spread it out a little bit so that it isn't as hurtful. But yeah, that's what they did. And because you're talking about driving on the weekend, that was my weekend car, because I'm like, oh, free miles, why not, put it instead. So and she warned me that was going to happen. And I was like, okay, better than using up my car and having to get the oil changed sooner and stuff. But yeah, there was a cost associated with that. All right. So let's see, there was another one. Oh, they put this as losing money consistently, but they were really talking about hobby losses. And so my own personal experience of that, along with you, Adam, was, if you remember a few years ago, about a decade ago, I said, hey, my daughter's picked up this little sport. It's called equestrian. And so I have this fantastic idea that I'm going to turn into a business. So she's a pretty good writer. And so, I will get a horse or two with the understanding that it's like kind of like my own little 1031 exchange. Sell one, buy another one, sell one, buy another one kind of thing. And it would be the horse that she's riding, or we would lease it out. And didn't quite turn out that way. Like the buying and selling didn't happen as often because she fell in love with the horse and was doing really well on it, et cetera. So there's a whole bunch of reasons why that didn't happen. But I did. I opened up my own LLC. I had credit cards for the LLC, a checking account. I pay all expenses, and I had this great idea that I was going to deduct those losses. And then I said, Adam, what do you think about that? And he said, my problem was I asked you after I had done all this stuff. And so that's problem number one. And then Adam says, no, you can't do that. And I said, the typical response, but why? And then he told me, and I said, but why? And just kept saying, no, no, no. And so we did continue with the entity, but I never deducted those losses because you actually sent me articles. And I think it was one of the Hilton kids, that same thing, got hammered by the IRS for trying to deduct equestrian related hobby losses. So, but what they're saying is that, deductions for legitimate businesses versus it being hobbies is something that gets red flagged apparently a lot. So it doesn't have to be equestrian, but other stuff.
Yeah, no, that's a classic, hey, I'm gonna get an RV and I'm gonna travel around and, kind of do ratings of RV park sites and hopefully solicit some advertisers as part of that. So can I deduct the RV? I mean, like Jack's case, appreciate that. I mean, the problem is, like, could you do that in a year? Yeah. Could you do it in 2 years, 3 years? I mean, that's kind of the when it starts triggering the hobby losses, maybe, but the problem that it raises is, like, at some point you got to start bringing in some top line. Like it's hard to say that I have a legitimate business that never brings in a freaking sale, but I tried really hard. Kind of suck at it.
Yeah.
You can bring in a sale.
It's either a hobby or you're just terrible and you're not made to do that.
Yeah, that's right. Then I think, in Jack's also particular case with horses, I mean, is it the horse itself, like it's actually it's an asset that you're training. So really it's like either my ordinary course of business is, buying and selling horses, in which case I have ordinary income or ordinary losses, or otherwise I've got a capital asset that I'm investing in that I sell for a gain or a loss. So you just, one to grow on, kids.
So Bruce, thank you for chiming in on this. Here's the question. Are deductions for physical assets donated if they are already fully depreciated? And then
Let me start by answering that question.
Okay.
The answer to that is negative, Ghost Rider. That pattern is full. You already got your tax deduction. You can't take it twice.
The double dip doesn't work in chips or in some of these deductions.
Right.
Okay. So just remember that when you're going in for the double dip during Super Bowl. Next question. Does any of the expenses of transporting it to the donation site or performing some minimal repairs to get it operational? I can think of one of my brother-in-laws riding lawnmowers. To get it operational so that the donation will be accepted, can that be considered the value of the asset donation?
Yeah, it's just that yes, that could. It's just remember that the charitable deduction mileage rate sucks. Like, I'm sure it's probably changed a little bit with inflation, but it still sucks. It's not the same as the business mileage rate.
Okay.
In other words, the juice, as my partner Jeff would say, the juice may not be worth the squeeze. I mean, it's always something, but it's like, I don't know. After you do all that, you may end up with like a $300 deduction, which isn't nothing, but at the same time, it's not much relative to the documentation required to substantiate that.
Yeah. Jack, you got another question?
All right, let's see. So, running a cash heavy business. when I saw this, I was thinking, so let's see your movie trivia. There was a movie and there was a scene where they were in a bar. The bartender opens, punches in the amount, pushes the cash register, and pushes that total button, and the drawer comes out, and then he reaches down and he slides it and puts it into his pocket.
Roadhouse.
Roadhouse, Patrick Swayze.
Right.
Yes,
Right.
absolutely. So,
Being remade, by the way, with Channing Tatum.
oh, I didn't know that.
I think
Fantastic.
Channing Tatum. Yeah.
Okay. Yeah, so business owners forget to declare some cash income that might otherwise be reported. So, and they said examples are convenience stores, restaurants, laundromats, car washes, and beauty salons. So, and quite candidly, I think that is saying, hey, you owners are doing this, because I think that many of these places are going to have cameras and the owners are watching to make sure that stuff doesn't happen. So they're basically saying it's the owners that are engaging in bad behavior and not necessarily the employees.
So before we move on from that one, did you see there was a headline that came across my news feed this week that North Carolina is trying to mandate that all businesses accept cash?
I had not seen that. I would think you're going in the opposite direction, but I also understand accessibility to cash, maybe easier.
I thought that was interesting. Now, it hasn't become law, but it's something that the North Carolina legislature is debating.
Yeah. So to quote Jay-Z, I got 99 problems, and that was not one of them.
This article, just kind of getting to the end.
Teacher pay, people. Teacher pay. Teacher pay.
This article at the end says, okay, you've been audited. Now what do you do, kind of thing. And so the first thing they say is don't panic. Good advice. Yeah, don't panic. But the reality is that, and I haven't had the benefit of dealing with a lot of IRS agents, either personally or professionally, thank goodness. But the ones that I have, most of them seem pretty friendly on the phone and are like, oh, I'm just going through this process. And again, I'm not throwing any IRS agents under the bus, or trying to perpetuate a stereotype, but I'm about to do that anyway, which is that they try to be very nice and they try to get where they're going to go and get the information they need, and then they're going to hammer you over the head likely. I've had to assist with offers in compromise, where they seem to be very nice about things, and then the offer that they put on the table after receiving information is not as friendly as the person who was asking the questions just a few weeks ago, a few months ago. So I don't know if you guys have similar experiences, or if they are equally nice or equitably nice in the results versus the way they are doing their due diligence.
No, so what I think where we most often see, nice person on the phone, mean person, show up, it's when people try to enter into installment agreements, where basically the IRS is acting as the bank, for you to get a big past tax liability done. Because it's part of that. If the balance is big enough, you're required to fill out an asset disclosure, and you got to disclose your assets. It's like that's all of them. And like they'll you'll get a jackass that will take as maybe rightfully so. They'll take the position, I see that you have, $500,000 in equity in your house, Gary, and you owe us $300,000. I would like you to explain to me why you're not using your home equity line to pay us off, and you believe that the government should be the bank of choice for you. And Gary saying, I don't want to have my home equity. Sometimes you get somebody who listens, sometimes you won't. But that's usually where I see the jackassery most often show up, is that they don't have, like, basically they want you to use them as the financier of last resort, even if some of the sources that they think are the right sources are really not the right sources.
Speaking of that, I'd like to know,
because like you take that same scenario, it's like what they don't know, Gary, don't panic on me. What they don't know is, like, they might have just announced layoffs at Gary's job, and he's like, shit, I'm gonna be next. I kind of need to, keep that money on deck. They don't know, they don't know that maybe there's something else coming up. Like maybe Gary didn't save for his kid's college, and that's what he's going to use to pay for college. Like they don't take that kind of stuff into consideration. That really, for a lot of people, that really is meant to be, I don't have a rainy day fund. My home equity line is my rainy day.
Yeah.
Emergency shit shit hits the fan fund. And once you tap it, you not tap it. Again. So that's where I see the biggest problems come up.
What do you think about?
Sorry, let me close on that.
Okay.
I mean, I'm joking about the 87,000, IRS agents. I mean, they're so short staffed now that honestly, this is embarrassing to say. The advice that I've had for my clients now is just freaking stall them and try to get it paid off in 2 years anyway. And they won't, like, nobody's going to actually say anything about that, one way or the other. Probably going to get sued for that, Gary. I apologize about it, but that's just the practicality of what's really occurred.
We did have an example as a partner in a restaurant, and they hadn't filed taxes and they were in trouble. And this was before they came to us, and they came to us with the shoebox on fire. What do I do? What was interesting is enough time had passed, and this guy was worried, like it was just killing him. When we dove into it to help him, they're like, yeah, it's passed. And he just got off, but which was a very interesting thing. I'd never seen that or before or since. But let's talk about, the Optima tax relief and some of those guys that, hey, you owe a bunch of money to the IRS, we can get you pennies on the dollar. Have we seen 0 times?
Yeah. Honestly, like, I'm sure there's probably somebody that has had relief from Optima tax relief, but the only scenarios that I've seen are, they took the client's money in the form of the deposit and then did nothing, literally did nothing.
Wow.
Did nothing for them. I mean, generally what the IRS is going to want to see is that, like, they're not going to absolve you of the liability unless, like, you didn't rack it up in the first place. Like, it wasn't, injured spouse relief would be an example of that, meaning like husband ran up the debt, you didn't know it, he forged your name on the tax return, now you're divorced because he was a cheating son of a bitch. Like, the spouse could get out of that potentially if she files for injured tax relief, injured spouse relief. But outside of that, like, you need to be on, like, death's door, like, not, you see these commercials of people like sitting in a vacation home rose garden. It's like, I don't know, man. I don't know what they're doing, but my calls with IRS don't go like that. So, I don't, unless you really have a provable, not my dog ate my homework type case, they're gonna leave it hanging out there because they're just hoping, like, they're hoping at some point they'll be able to collect it. I mean, they'll, file lien against your house, go sell your house. Guess what? They're going to get paid.
Yeah. It's interesting. We do see a lot of prospects that come to us that have been kind of promised this or that by specialty groups. And we got one recently where they have 2 opportunity zones that they were told, well, CPAs don't know anything about this. Well, we do, and we have expertise in it. But some of the things that they were talking about, well, hey, we have the magic box, we have this and that. They had not prepared this particular business owner for some of the tests that have to be run twice a year against those opportunity zones. And so I think you have to be extremely careful on these people that say, oh, well, CPAs don't know anything about this. I mean, run-of-the-mill CPAs may not run into some of those kind of things like opportunity zones enough to where they're proficient at it. They really don't know what they're doing. But and we saw this in the ERC world, still a lot of people. Now it's waning, and that's starting to pass. But I still hear plenty of commercials on the radio about these people finding all kinds of money for companies, and it's like, you just better be careful, because they may not be around. And then if you have to stand in front of the IRS, you better have somebody that knows what they're doing, and they still can't defend you if you broke the law or you weren't buttoned up.
Yeah, I can't remember the name of the company. It wasn't Optima, but it was one very similar to Optima. Yeah, they just got raided by the Department of Treasury, by the way.
Really?
Like 6 months ago. So it's like, don't, again. And sorry, I'll go last funny story because Jack actually knows this guy. I had a client that owns a bunch of dental practices that was approached by one of these tax credit companies after a conference, said, his guy's saying that as a dentist, I qualify for the research and development credit. And I was like, I don't know, man. I mean, maybe if you were doing, custom ortho, something or other that had never been done before, kind of, no, he's like, no. If I go and learn a new procedure at a conference, and then I implement, new way to clean teeth, and then implement it in my practice, that's R&D for me. I qualify. That's what this guy says. I'm like, that's freaking crazy. Like, no way, no how. And I'm like, remember, I'm pro deduction, but like, I need to know more, about that. So, I have a friend of me who is also in the CPA world that specializes in dental practice, who is equally as aggressive as I am. I called him up. I'm like, John, what are you guys hearing about this stuff? He's like, it's such a load of BS. We're not touching it with a 10-foot ball. I'm like, maybe feel a little bit better. I'm not the crazy conservative one. Even John, who is just as aggressive as I am, is like, that is nuts and is not going to pass. Again, same company, rated by the IRS months later. So it's like,
Wow.
There you go.
Wow.
In other words, like, you go back to the dental example, what finally put a nail in it for me, it's like, if these companies, the R&D credit's been around forever. If these companies had thought dentists qualified for the R&D credit, why are they freaking bringing it up now in 2022 instead, this 2022 at the time, instead of, in 1980 something, when it was created? It's like, it's because they've exhausted all other opportunities. So let's start trying to, I don't know, maybe we'll try these guys.
And maybe there'll be a little less of that, since they just passed a new update on that R&D tax credit, where it's now 3-year amortization. So you don't get that full benefit of deducting all that up front. We've got a lot of experience in that too. And maybe not everybody does, but man, when somebody's promising stuff, if it's too good to be true, it might be.
And I'll throw in two kind of tangentially related things. First, I guess this is the segment of additional free legal advice, which is that if you own a trademark, oh gosh, did I say that out loud?
Yeah.
Jeez,
Yeah.
Okay. Guidance. All right. If you own a federal trademark at way early than when is needed, meaning that you have to file something around your 5th year of having it, your 10th year, and then every 10 years then after, you'll get hit up from this company or companies that look very official, that says, the United States trademark filing office, which is, they will do what they say they're going to do in most cases, which is file your renewals and charge you a lot of money for that. But it is not, you don't have to pay them the bounty in order for them to do that, but people get scared. And so I get clients all the time, is this legit? Is this legit? I'm like, no, we got you covered. We will get in touch with you at least 6 months prior to when you have to file whatever you need to file. We have a docketing system. Everything's good. Relatedly, and this is more of a general statement, that there are all kinds of people out there that take advantage of their position or their knowledge. And that's a very broad statement. Let me give you a specific example that I had to deal with yesterday, which is I had a client send to me a letter that it is an attorney, a law firm from out of town, seeking information about a vehicle that was serviced at my client's location because they have a lawsuit against the manufacturer. And they wanted to, get this information. And in the letter, it said, there is a lawsuit that's been filed, but it said, we don't want to have to, in essence, it said, we don't want to have to drag you into the lawsuit. So we ask that you send us the information we're requesting. What they need to do in order to get this information, and I confirm this with my litigator that I'm not just not being a jackass about it, but it's the proper that they need to get a proper subpoena filed in Mecklenburg County, because that's where this client is. And the states have different forms of subpoenas. And so I've also had an out-of-town subpoena. It looks very official. And my guys upstairs in our litigation group said, you don't have to do anything. You may want to tell them that they're mistaken. That way they don't keep hounding our client. But I will be responding back to that attorney saying, yeah, we're not going to do anything until you do what you're supposed to do. And I'm not going to guide them as to what they need to do. And, the option is to not do anything, but I think they will continue to be aggressive if we don't tell them, hey, there's a lawyer on the scene and we're not going to do anything about that. So my point is that we all, many of us get stuff in the mail or emails that look very official, and just beware of that, because I'm seeing that happen more and more, and they use scare tactics to get you to comply. And so, follow your gut, because it'll probably guide you to the right place.
So this applies to you, Jack, as well as you, Adam. Let's say you get a phone call and it's a very interesting accent, foreign accent, and they're from the IRS calling you because you owe them money right away. Is that legit?
How friendly is the voice? What kind of accent?
Not very
is it?
friendly.
No,
I've gotten a few of those calls before.
It's not a very exotic male or female voice that is trying to. There actually is science behind the pitch of a voice. There was someone in our office that she could Jedi mind trick anybody into anything as on the phone, as far as trying to get information from the Secretary of State's office. And I would just, hear her talk, and her voice drops a few octaves and becomes very friendly and very warming and motherly kind of thing. And then I've heard others who it's like, cool British accent, and, sounds it's kind of like that commercial. There's a commercial out there, and it's, I don't work for the company. I'm just a good looking paid British actor kind of thing, So, but yeah, I would not suggest. Now, if you want to mess with them, if they're actually live on the phone and start asking for them to tell you your own social security number and say you forgot it, and can you give them a few hints? I've done that before too. It's like, is there a 7 in it? Yeah, and just see what they say. It frustrates them big time.
Yeah, they got their just desserts. That's good. Well, this has been an interesting conversation today. Any questions from the gallery? You guys were way too quiet on the chat. I'm so sorry that we couldn't do the poll to just see how the bar charts move across, but I'll have to do some deeper digging into my current polls and clean those things out to make them work next time. Oh, speaking of next time, we've got the Ben McDonald of BGW Wealth that's going to be joining us, and we're going to do a deeper dive on the Secure Act. So Jack will want to weigh in on that one as well. We're going to give Adam a pass so he can go visit his family, which is a good thing. But Ben McDonald and Jack and I'll be back next week on Secure Act and anything you want to talk about. So any final questions for Adam or Jack before we're wrapping it up today? Oh, Jack, while we're waiting, real quick question. So here's the scenario. Business owner owns a couple Kias or Hyundais in their fleet for service vehicles or whatever. And because those vehicles are now on the target list by certain insurance companies, they are uninsurable. They're new cars, but they're uninsurable because Kia Hyundai did not follow protocol on securing anti-theft devices on these vehicles. So, TikTokers did YouTubes on, hey, this is how you rip off these cars and steal them, and people have been doing it. What do you do?
Yeah. So, there's different angles to that. Obviously, the insurance companies can pick and choose who they want to insure. There is a distinction between new policies and current policies. And I think that it would be hard for an insurance company to basically dump someone because they now own a vehicle that has been blacklisted by the industry, essentially. So I don't know if this is more than a Jack theory, but I'm not sure 100% on this, that you can actually you maintain your policy. My parents own one. I don't think it's in the range of where the issues are on the security issue. So thank you for the reminder. I meant to get out, talk to them about that. But so from the insurance perspective, I think that's the insurance perspective. From the manufacturer's perspective, they obviously are going to have to fix the problem and then retrofit and create a solution with a recall and fix that to the extent they can fix that, because they are about to get hit with a bunch of lawsuits, especially not just the ones that have been stolen, but the ones that potentially could be stolen. And it's like, well, I can't drive my car anywhere. It has to sit in the garage because I'm afraid someone's going to take it. And so, there's that issue. And then, what do you do as a car owner? And you just have been told that you drive your car and you park it somewhere. It might not be there when you come back. And so, it's created a lot of stir and hubbub, and like many issues is going to create a lot of legal problems for many different constituencies or many groups of people. Like I said, the insurance companies, what is their responsibility? Are they able to dump you? Are they able to say no? Is that some sort of discrimination? I mean, imagine the case that, let's assume for discussion purposes, I mean, it's actual that, those cars are less expensive than a BMW or a Mercedes, right? Okay. So now is there some sort of discrimination, income discrimination, low income discrimination by the insurance companies who are saying, well, we're not going to insure these vehicles, but the impact of that is that lower income families cannot get insurance on the vehicles that they can afford. So throw that mess into the mix, right? I mean, probably hadn't even thought about that until I didn't think about that until just now. So yeah, a lot of issues.
Well, we're going to go ahead and sign off. Adam had to scoot to go meet with a client. So anyway, we'll be back for week 146 next week, Lord willing. And again, we'll have Ben McDonald on here to talk about Secure Act. If anybody came on here late, we will put it up on the BGW CPA YouTube channel. And I think Jack and those guys may do their own thing as well. But Jack, it's always good to be with you. Thank you for your time. Thank you, everybody, for entrusting an hour of your time to us. Hopefully, we're making it worth your time. Thank you again. And Bruce, thank you for your questions today. Appreciate it. You guys have a great rest of the week. Stay dry out there. We'll see you next week.
Thank you.
Bye-bye.